A lot of people hate their job. A lot of people are trapped in their 9-to-5 jobs. However, it's very hard and difficult to get out of that rat race. I understand that not everyone must leave their 9-to-5, but if you are someone who wants to leave their 9-to-5, this video is for you. We are going to delve into a strategy, which is basically a swing trading strategy. I will provide you the entry parameters, the analysis stages, as well as how you are going to exit that particular market. I understand trading is very difficult, but if you put in the effort that is required to master this craft, I really guarantee you see results. All that you need to do is to incorporate everything that is required for success, which is generally the technical side of things as well as the trading psychology side of things. Without further ado, let's jump right into the video. So there's a popular saying that says, simplicity is the ultimate sophistication. It's one of my favorite sayings when it comes to business or even trading. The money you are looking for is in the simple stuff, and I always say focus on the simple techniques in trading. You have clicked this video because either you are tired of that job or you are looking to get a proper full-time income. I cannot guarantee because I do not have access to other areas of your trading. But what I can guarantee is if you follow the stuff that I'll provide you in this video, as well as work on your other side of trading, which are trading psychology and so forth, you will definitely make it. So this strategy is simple and will help you achieve that only if you are patient to wait for the points I will show you. Alright, so the first part is strategy definition. Let's define this particular strategy so that we can understand how to utilize it. So the biggest thing that affects traders is overtrading. I have been one of those type of traders who actually had 80 to 100 entries in a month, thinking that trading more will actually give me money, but that is the opposite. The lesser, the better. So this strategy will utilize the daily time frame and the H1 or H4 time frame. You only need the daily or the H1 time frame, or basically the daily and the H4 time frame, depending with the time you have with the markets. If it falls under the swing trading strategy, where you catch big moves and hold them for long, we are looking at holding a trade for maybe a week, or in some instances maybe a month. So the sequence of approach will be, we are going to start on the daily time frame. Then on the daily time frame, that is where we get what we call the point of market interest. Then we go to the H1 time frame. Then we go to the entry. And if we have that, let me now explain the next stage. All right, so this is the model that we are going to be following. The model is simple. This is the daily time frame, and this is the H1 or H4 time frame. What we are going to look for on the daily time frame is basically two impulses in one particular direction, where the first impulse is breaking the law of the second impulse is breaking the law of the first impulse, like that. When this happens, all that we now require is this particular point of market interest, which is a zone that we would expect to see the market to pull back in that particular zone. I'll show you how to draw this zone when we get over to the charts. Then on the H1 time frame, this is what we look for. We need to see an M pattern, and if that M pattern gives us a page, which is basically a liquidity grab above the first leg level, will be a perfect pattern. So in this case, it's either it will be like this or it will be basically like this within this zone or this point of market interest. All right, so we now need to move to market examples to understand this particular method. Before we do that, check out our free Telegram channel. I'll leave the link in the description box below. All right, so in this case, I'm going to use two currency pairs as well as an index, which is basically NASDAQ or USA 100. So in this case, I want us to go back in history so that we can see and then make an anticipation of what we want to see next. When you come to the charts, the first step is to always analyze the markets. So analysis always is the starting point. In this case, I am on the daily time frame. We can see that from this particular point, we had two impulses to the upside, which is one pullback, then two, and this second impulse actually broke the high of the previous impulse. When we are drawing our zone, we want to catch the highest point of the weekly or of the week to the high, to the open, to the close, sorry, to the close of the candle. So in this case, we have obtained the high of the candle, of this highest candle, to the close, to the open of that particular, so to the close of that particular candle. And then we now wait for market to tap into our zone of market interest, like that. So that is how we draw the zones. In this case, we had an impulse, another impulse, but unfortunately the market did not retrace enough to reach our zone of market interest. So if we look at the current price, which is this one, we are expecting to see the market to drop and reach this particular zone of market interest. We have the high and the low like this. So our anticipation or our expectation will be to see the market pull back and reach our point of interest, and then we get our W pattern, in this case on the H1 time frame, to go to the upside, basically like that. So if we check the H1 time frame to see this particular point, for us to get an entry, it will look like this. So this is how it was going to be like. We can see this is the first leg, the second leg, and in this case they gave it as a triple bottom, or basically a three-legged W pattern. And then from there, our entry will be basically at a candlestick reversal pattern on the second leg. So in this case, our entry was going to be at this particular point, which is this one, right? And the market went to the upside, basically like that. We can see how long it took. So I always advise to take at least 2 H4 levels, which are basically 6 H1 levels in one particular direction. So if we look at the daily time frame, we can see this particular move to the upside. Then we can have another example now on NAS, and NAS is something that is loved by a lot of people, and the same concept is applicable. We can see from this particular point, we had the first impulse to the upside, pull back, second impulse to the upside. We draw our point of interest, basically like that. Then the high, which is this one, and the low, we protrude it into the future for us to get the point of interest, which is a retracement of market to that particular point. You can see and look for the pattern. We can see that when they came back to the point of interest, there was a clear pattern. Of course, they initiated this retest, but there was no pattern here. But when they came back, we can see a beautiful W pattern for us to make an entry. We've said on the second leg, that is where we intend to look for a candlestick reversal pattern that actually give us an entry, basically like that. So this is how you will be getting the swing entries that last long and that does not require a lot of time for you to be in front of the charts. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.